Hello everyone. Today let's explore a crucial aspect of governance in India, the union budget and how it compares with the state budgets. This video highlights the fiscal strategy of the central and state governments and gives us a glimpse into the nation's financial health and development plans. Every year, the central government presents an annual financial statement known as the union budget. This is not just a document. It is an outline of how the government plans to manage the country's revenue and expenses in the upcoming fiscal year. The finance minister, who holds the responsibility for the nation's financial well-being, unveils the union budget in Parliament, outlining not just figures but the direction of the country's economic policies. A key section of the union budget is revenue generation. The government estimates how much money it will accumulate from various sources such as taxes like income tax, GST and customs duties, and non-tax revenues like the profits the government earns from public enterprises or interest payments on loans. This revenue essentially fuels the government's engine, allowing it to fund national initiatives. On the other hand, the expenditure segment shows where this money is to be spent. This includes defense, infrastructure, healthcare, education, and social welfare programs. The expenditure part of the budget tells us what sectors the government considers important for the year ahead and how much investment these sectors will receive. Now, what happens when the expenditure is more than the revenue? This gap is called the fiscal deficit. The government must bridge this deficit, and they usually do so through borrowing or other financial strategies. This deficit is a key metric watched by economists and policymakers to measure how sustainable the government's spending is. As I've already mentioned, the union budget is not just a balance sheet. It often introduces new policies, reforms, and initiatives to tackle the country's immediate challenges or to push forward long-term development goals. These announcements affect various sectors of the economy and impact citizens directly as well as indirectly. Now you might be wondering, does the state government also present its own budget? Absolutely. Each state in India presents its state budget, which functions similarly to the union budget but focuses on the state's unique financial requirements and local governance. Just like the union budget, it lays out the revenue sources and expenditures at a state level. There are some fundamental differences between the union and state budgets. First, the scope of the union budget is national. It handles larger, country-wide concerns such as defense and national infrastructure. On the other hand, the state budget is more localized, focusing on issues like law enforcement, local healthcare systems, and education specific to the state's needs. The revenue structure also differs. States generate revenue from sources like state GST, property tax, and excise duties. However, a substantial part of a state's income comes from grants and transfers from the central government. This highlights the independence of the union and state budgets. So both the union and state budgets are vital components of the country's fiscal framework. Together, they shape the financial landscape of the nation, balancing national priorities with state-specific challenges. Having a thorough understanding of both budgets helps you stay informed about country-wide financial matters. If you are into commerce and want to work with concepts related to the union budget, state budgets, and government financial planning, commerce professional courses like CA, ACCA, and CMA India are the best choices for you. And the Indian Institute of Commerce Lakshya is the top-tier provider of these courses in the world. Enroll us today and land your dream career. Thank you so much for joining us today, and to watch more insightful videos like this, do subscribe to our YouTube channel.